Good morning. Thank you for joining us this morning. We're going to go over your questions. We're also going to go over the self-directed 401k. As always, you can follow the conversation on our community site, which is mysolo401k.net/my community. We've got thousands of members there who are constantly posting forums. We have a large video of blog posts there as well. So today we're going to cover how the self-directed 401k works, also known as a self-directed solo 401k plan. To qualify for a self-directed 401k, you have to be self-employed. So it's got to be an owner-only business that does not employ any non-owner common law full-time W-2 employees who work 1,000 hours or more in the self-employed business. Your spouse can also participate in the plan. So as long as your spouse also works in the business, it would just be one self-directed 401k. Both spouses would be considered participants in the same solo 401k plan. Here's an example of a one participant self-directed 401k plan. So under the self-directed 401k plan, you need to have separate holding accounts for each source of self-directed 401k funds. This illustration here consists of 3 separate bank and or brokerage accounts under one plan. The first one is labeled pre-tax, the second one is labeled Roth, and the third one is labeled after-tax, which is part of the voluntary after-tax self-directed 401k, which is used for the mega backdoor Roth self-directed 401k. So in review, one plan, 3 separate holding accounts. This next slide here is an example of a 2-participant plan. For instance, both spouses work under the same self-employed business. Let's say it's a LLC. So the self-employed LLC business sponsors the self-directed 401k. Both spouses have decided to participate in the plan. So instead of opening 3 separate bank or brokerage accounts under the self-directed 401k, it would be a total of 6 bank or brokerage accounts. So 3 for each participant and a different for each source of funds. That's pre-tax, Roth, and voluntary after-tax funds. It's worth noting that the self-directed 401k, aka solo 401k plan offered by my solo 401k Financial, allows for all these contribution types, especially the voluntary after-tax self-directed 401k, which is part of the mega backdoor self-directed Roth 401k. You don't have to utilize all these contribution types, but they are built into the plan, which means you can use the different sources down the road. Of course, not everybody qualifies for a self-directed 401k, but those that do qualify will want to take a look at our self-directed 401k eligibility list. For instance, it does not need to be a formal entity like an LLC in order to have a self-employed business that would qualify to open a self-directed 401k. As a matter of fact, many of our clients are Schedule C clients or Schedule F clients. Schedule C is for contractors, freelancers. That's the tax return that they file for their business, which is attached to their Form 1040. Schedule F is for farmers. Of course, it can also be an LLC, taxed as an S corporation or a partnership. So in short, the entity type does not matter with regards to sponsoring the self-directed 401k. What matters is that you are doing material services under that applicable business that constitutes earned income from self-employment activity. And then in turn, you're going to report that self-employment activity on your business tax return. whether it's a Schedule C for a sole proprietorship, a Schedule F for a farming business. For an S corporation, it would be Form 1120S. C corporation, Form 1120. Partnership would be Form 1065. And there's no minimum of self-employment income required in order to qualify for a solo 401k. What matters is that you're doing the material services. Your business may have a net profit or a net loss. That doesn't mean you did not perform any self-employment activity. So the key is to be doing those material services, and you can learn more about those material services definition by referencing IRS publication number 560, the publication for self-employed plans, including self-directed 401k plans. Yes, your spouse can also participate in the plan, as I just went over a couple slides ago. In some instances, you might even have a daytime job and you participate in that daytime employer's 401k. You also have a self-employed business, and you also open a self-directed 401k for your self-employed business, resulting in two separate 401k plans. That is one with your daytime employer and the second one for your self-employed business. Contributions to that self-directed 401k would be based on your net self-employment income from your self-employed business, not your day job. Also, you can utilize the Mega Backdoor Roth self-directed 401k by making the overall contribution limit of $70,000 for 2025, for example, irrespective of you contributing to your daytime job employer 401k, which means that if you maximize your daytime employer 401k contributions, you're still going to be able to maximize your voluntary after-tax contributions to the self-directed 401k and then convert it to the self-directed Roth 401k or a Roth IRA as part of the Mega Backdoor. So that's an example of how you can really utilize a self-directed 401k in conjunction with your daytime employer 401k. The self-directed 401k requires its own separate employer identification number, so EIN. You cannot use the business EIN or your social security number. That EIN number specific to the self-directed 401k is going to be used when opening up the bank and or brokerage accounts, when reporting distributions from the self-directed 401k, as well as conversions, whether it's pre-tax and plan self-directed 401k conversions to the self-directed Roth 401k to the Mega Backdoor, where you make a voluntary after-tax contribution to the voluntary after-tax self-directed 401k holding account, and then immediately convert that over to the self-directed Roth 401k. So that employer identification number is important because we have to use that on that Form 1099-R to report those types of transactions, whether it's distributions or conversions. All right, so let's keep moving on here. So a self-directed 401k, you really need to make sure you understand compliance items, such as understanding that it's for owner-only businesses with no full-time W-2 employees that are not owners in the business. And that's true across all the businesses under your control. So any business that you own that employs a full-time W-2 employee who is not an owner, that would preclude you from being able to open a self-directed 401k. Now, when investing in a self-directed 401k, you need to understand the types of investments that are allowed under that type of self-directed 401k. So in addition to being able to invest in traditional investments, such as equities, whether it's stocks, index funds, exchange-traded funds, to even CDs or bonds, the self-directed 401k regulations also allow for investing in alternative investments, such as real estate, promissory notes, and other types of alternative investments like precious metals, cryptocurrency, tax liens, tax deeds, judgments, life settlements, private funds, whether it's private equity or real estate syndicates, to even crowdfunding and even foreign currency, to name some of those alternative investment types. In the context of real estate, let's talk about that a little bit. So with real estate, you can invest in physical residential real estate, whether it's commercial real estate, physical land. It can be foreclosures, rehabs, and of course, private syndicates. From a promissory note investment side of things, it can be mortgages, whether it's secured or unsecured, often known as trust deeds. You can even invest in car paper, commercial paper as well. You cannot invest in actual vehicles. So your self-directed 401k cannot buy an antique car or a Ferrari or any type of car, but it can invest in car paper, just not actual vehicles. Those are not allowed. Okay, let's keep moving on here. Now, when investing in a self-directed 401k, especially in alternative investments, you need to be aware of the prohibited transaction rules. So just like self-directed IRAs are subject to the prohibited transaction regulations, the same is true for the self-directed 401k, also known as a self-directed solo 401k. In the context of real estate, some examples of prohibited transactions are selling a property that you, the solo 401k or self-directed 401k participant, own. So you can't sell your home, whether it's your primary residence or your personal investment property. It's prohibited to sell or exchange that property to the self-directed 401k. It doesn't matter whether it's at fair market value or not, it's prohibited. You also cannot use the self-directed 401k owned property as security for a loan that you might get from a bank for you personally, or a loan to your own business from a bank. So it's prohibited to use any of the 401k owned investments, even equities. You cannot use those as security for a loan from a bank or an unrelated party out there. And of course, you can never use property owned by the self-directed 401k for personal use. So if the self-directed 401k owns a property, you cannot use it even for a day out of the year. So it's not allowed to, you're not allowed to use a property that's owned by your self-directed 401k because you are considered a disqualified party. Same is true for certain relatives, such as your children, your parents, and of course your spouse. Those are all disqualified parties. A self-directed 401k plan also commonly can be invested in promissory notes. That's where the self-directed 401k loans money to a third party. And it would be prohibited for that self-directed 401k loan to be to you through a promissory note. Don't confuse the self-directed 401k participant loan rules. Those are different. That's where you borrow from the self-directed 401k and you pay that self-directed 401k back. In the context of a promissory note, that's where it's an investment. It's not a loan. That means that the self-directed 401k loans money to a third party. So you cannot do that as an investment to yourself. That's prohibited. Nor can you loan the funds from your self-directed 401k to your spouse or certain relatives, such as your children and parents. Nor can you loan those self-directed 401k funds to your own business. You can, of course, take a self-directed 401k participant loan within the limits, and we'll talk about that more, and then you can turn around once you borrow from that self-directed 401k, you can then use those funds for any purpose, including investing them in your own business. But this here is different. This is where the self-directed 401k performs an investment. So it's not a participant loan. It can be a little confusing, I know. Okay, why would you want to open up a self-directed 401k? As we've touched on already, it allows you to invest not only in equities, but also alternative investments. And it can all be done by checkbook or wire control. So a self-directed 401k offered by my solo 401k Financial allows you to invest in equities. Obviously, you don't need a checkbook to place those types of investments. Those will be placed under the self-directed 401k brokerage account, which we can help you open up at your brokerage of choice, including Fidelity and Schwab, which are two common ones our clients will use. If you use Fidelity or Schwab, for instance, they'll provide brokerage accounts for the self-directed 401k plan that we offer, and you'll be able to invest by wiring funds out of the plan or by check for the purchase of real estate and even promissory notes or precious metals to even private placements. So that's where the whole checkbook and wire control comes into play with the self-directed 401k. It's when you're placing alternative investments. So our plan covers all investment types, whether it's traditional investments to alternative investments. Now let's talk about some disallowed self-directed 401k investments. So typical disallowed investments in a self-directed 401k, aka solo 401k, are collectibles, such as work of art, rugs, antiques, gems like diamonds, emeralds, any type of gem, stamps, alcoholic beverages. Doesn't matter whether it's whiskey, tequila, or fine wine. Those are all disallowed investments. Musical instruments, certain types of precious metals. So most precious metals are allowed. They have to be at 99.99% purity. We have a great page on our website that goes over the types of allowed precious metals, but not all of them are allowed. So let's keep moving on here. Disqualified persons. We touched on this already. Here are examples of disqualified self-directed 401k individuals. So your spouse. So these are individuals that you cannot invest your self-directed 401k with. So your spouse, your natural children, your adoptive children, your spouse, your spouse's natural children, essentially anyone that also provides services to the 401k plan, such as your CPA or your attorney or even your self-directed 401k provider. It would be prohibited to do an investment with your self-directed 401k provider because they're disqualified parties. As well as entities controlled by your family members. So if your son has a corporation, your self-directed 401k cannot do business with that corporation owned by your son. As well as your trust. Let's say you have a living trust or a land trust. You cannot utilize your self-directed 401k to invest with that land trust or living trust. Okay, let's talk about the self-directed 401k contributions. So self-directed 401k is very popular for maximizing contributions, whether we're talking about pre-tax contributions to Roth contributions, whether employee or employer Roth, self-directed 401k contributions to self-directed 401k voluntary after-tax contributions. The self-directed 401k allows for all these types of contributions. So for instance, for the tax year 2024, the overall contribution limit is $69,000 to a self-directed 401k. So if you have a self-directed 401k already, or you opened it at the end of last year, then you have until your business tax return due date plus timely filed extension to make those 2024 contributions to the self-directed 401k. For 2025, the contribution limit increased by $1,000 to $70,000. There's also a catch-up contribution of $7,500, which stayed the same as 2024. However, there's an additional super catch-up contribution. It's known as the super catch-up. It's only available for those who are age 60, 61, 62, or 63 in 2025. So it's only available for 2025 and future years. Under that super catch-up amount, instead of contributing $7,500, you can contribute $11,250. Obviously, you can't contribute both, but you can contribute that $11,250 amount instead of the $7,500, as long as you fall within that age range there of 60 through 63. So this slide here goes over the contribution deadlines, which apply to both employee and employer contributions. This is for tax year 2024. So you still have time here in 2025 to make both employee and employer self-directed 401k contributions. This slide lists the different entity types: sole proprietorship, partnership, S corporation, C corporation, and so forth. The next slide goes over the 2025 self-directed 401k contribution deadlines. So this slide here is going to be useful for anyone that opens a self-directed 401k in 2025 and they want to make 2025 year self-directed 401k contributions. They can do it anytime here in 2025, or they can wait and do it next year in 2026 by the business tax return due date, including business tax return extension. So you're going to have plenty of time to make 2025 contributions well into next year. So the common question we get is how are self-directed 401k contributions accounted for and reported? So when you open a self-directed 401k, aka self-directed solo 401k plan, you're going to have those separate holding accounts I mentioned earlier. So here's a slide from earlier where it's a one participant, or this is a two participant plan where you're going to have separate holding accounts for each participant and separate sources. So the bank and or brokerage accounts will be used to track those contributions. That's how those contributions are accounted for, is by making them into those applicable self-directed 401k brokerage accounts or bank accounts. And then you're going to report those self-directed business tax return, and in some cases on your personal tax return. So in short, the self-directed 401k contributions are accounted for by making the deposits into the bank accounts or brokerage accounts specific to the self-directed 401k, and then they are reported on your business and or personal tax return depending on the contribution type. So you don't need to report self-directed 401k contributions to your self-directed 401k provider, because your self-directed 401k provider is not holding the funds. So here's an example. This slide here goes over how to report self-directed 401k contributions when your self-employed business is a sole proprietorship or an LLC tax as a sole proprietorship. We have a great link on our website to a page that goes over these contributions. We'll go over them at a high level here, but you can always refer back to these slides here. So for a sole proprietorship, you're going to report employee and employer contributions on Schedule 1, specifically line 16 of that Schedule 1. And that Schedule 1 is an attachment to your personal Form 1040 tax return. Now, Roth employee contributions do not get reported on a tax return. Instead, they're going to get reported indirectly on a Form 1099-R as part of the mega backdoor Roth self-directed 401k conversion. They'll be reported there, but they don't get reported on your personal or business tax return. Roth, there's also a new type of contribution known as a Roth employer contribution. Those are not tax deductible, of course. But if you make them as a pre-tax employer contribution, then they are going to be tax deductible. And that's going to be on line 16 of that same Schedule 1 of your Form 1040. Lastly, as I mentioned already, voluntary after-tax 401k, self-directed 401k contributions, aka solo 401k, they do not get reported on your personal tax return or your Schedule C if we're talking about a sole proprietorship. Instead, they get reported on Form 1099-R, line number 5. That's where they get reported when the self-directed 401k provider issues that Form 1099-R to report that voluntary after-tax self-directed 401k conversion. This slide here goes over the how to report contributions if your business is an LLC taxed as a partnership. So it even applies to a partnership. So again, we have this information on our website as well, but let's just go over a couple items here on that front. So you're going to report employee and employer pre-tax contributions if your business is taxed as a partnership. You're going to report those on line 16 of your Schedule 1 as well. And then you're also going to report them on your Schedule K1, line 13. You're going to use code R in line 13. Take a look at publication 560, page 15, where it talks about where to deduct contributions for more information on this. Now, Roth employee contributions do not get reported on a tax return. Roth employer contributions, so that's another type of contribution. And so instead of making employer pre-tax contributions, you can make Roth employer contributions. Now, those are going to be reported as tax deductible, which is interesting, right? It's going to be on line 16 of your Schedule 1, which is an attachment to Form 1040. And then on your Schedule K1, line 13, using code R. But then we're going to have to report that if you make a Roth employer contribution, yes, you get a deduction on the employer side, but then it's going to have to get reported as a taxable in-plant conversion on Form 1099-R. Talk about making your head spin. So they're going to have to be reported as a taxable in-plant conversion. So you're going to have to make sure you communicate that to us so that we can prepare that Form 1099-R. And of course, voluntary after-tax contributions are now reported on the tax return. They're indirectly reported on that Form 1099-R. That's for voluntary after-tax self-directed 401k contributions. Talk about all different rules based on the contribution type to make your head spin. Okay, if your business is taxed as an S corporation or C corporation where you're paying yourself a W-2 from that business, then this slide here goes over the contribution rules, how to report those on your taxes. So let's look at some of these items here. So reporting the contributions on your tax return depends on multiple factors, including whether your self-employed business is taxed as a C corporation versus an S corporation, and whether they're pre-tax employer contributions or Roth employer contributions, employee contributions, voluntary after-tax contributions, you name it. So if it's an S corporation, pre-tax and Roth profit-sharing contributions are going to be reported on your Form 1120S, specifically line 17. For a C corporation, the pre-tax, Roth, and employer profit-sharing contributions are reported on Form 1120, line 23. Now, for both an S corporation and a C corporation, employee contributions are reported on Schedule 1, line 16. For both S Corp and C Corporation, employee pre-tax contributions are reported on Schedule 1, line 16, just to repeat that. Alternatively, you can report those employee pre-tax contributions in box 12 of the Form W-2. So you get to choose where to report those employee pre-tax contributions. You're the one to report it on both places, so don't report them on Schedule 1 and on the W-2 because that'll result in a double deduction. So you got to pick one or the other. For voluntary after-tax contributions, they are not required to be reported, but you can certainly choose to do so. If you do, you're going to report those in box 14 of the Form W-2. Now, employee Roth contributions, those are reported in box 12A of Form W-2 using code AA, and then you're going to want to check off the box 13 titled Retirement Plan. So these are good slides for all these different contribution types. And then lastly, Roth employer contributions. Those are going to be reported on your 1120S or your 1120, depending on how your business is, whether your business is an S corporation or C corporation. But then we're going to have to make sure we report them on a Form 1099-R as a taxable and plan conversion if you make those employer Roth 401k contributions. We're not talking about employee Roth. We're talking about employer Roth, which is a new contribution type resulting from Secure 2.0 Act. So you'll get a deduction on the business side, but then we got to turn around and make sure it gets reported as a taxable and plan conversion on a Form 1099-R. So make sure you let us know so we can report that for you. All right, now that we've gone through all those different slides about how to report contributions, let's keep talking about other features of the self-directed 401k, such as participant loans. You can process a participant loan from your self-directed 401k where you, as the participant, borrow within the limits. You can borrow 50% of your self-directed 401k balance not to exceed 50,000. So in order to borrow the full 50,000, you're going to need a self-directed 401k with the value of at least 100,000. If it's valued at 60,000 instead, then you can only borrow $30,000. So the maximum is 50,000, but it's 50% of your total balance not to exceed 50,000. The long term is typically 5 years if you use the funds for any purpose. On the other hand, if you decide to use those funds towards the purchase of your primary residence, then the loan can be extended to 15 years, even 30 years. So you make payments monthly or quarterly over a 5-year period or over a 30-year period or 15-year period if it's for your primary residence. So there's that 15 and 30-year exception if the funds are used towards the purchase of your primary residence. Here are some of the loan requirements. And as part of our ongoing support, we'll draft the self-directed 401k participant loan documents. You have to use specific loan documents. The government requires specific loan documents used. You can't just put something on a napkin, in other words. So we would need to fill out a loan application, loan agreement, or we would prepare these, I should say, for your signature, and then a loan amortization schedule. Here are some of the rules that we kind of went over already. So loan payments, you have to make them according to the amortization schedule. They have to be level payments consisting of interest and principal. They're made quarterly, monthly over the life of the loan. 50, if the loan limit is 50,000, so 50% of your balance not to exceed 50,000. The loan interest rate is typically prime rate plus 1%. That interest goes back into your own 401k, so you're paying your 401k back. You're not paying us or the bank or brokerage firm. Those funds are going back into the self-directed 401k holding accounts, whether it's the bank or brokerage accounts. Another feature of the self-directed 401k, also known as a solo 401k plan, is that you can consolidate retirement plans, such as our former employer plan, whether it's a 401k, a defined benefit plan, 403b, 457 governmental plan, thrift savings plan, or a pension. Those can all be transferred to the self-directed 401k, as well as traditional IRAs, SIP IRAs, and simple IRAs. Those can all be transferred when you open the self-directed 401k or through the life of the plan. And it's important to note that transfers to the self-directed 401k do not count towards your annual contribution limits. So there's no limit on the amount that you can transfer from IRAs and former employer plans into the self-directed 401k. This is a good slide for those that like to invest in alternative investments, specifically those that want to invest their self-directed 401k in real estate, where they want to use a non-recourse loan, where the self-directed 401k obtains a non-recourse loan from a bank or a hard money lender, and then the self-directed 401k uses those funds to invest in a property. So if a self-directed IRA does this type of setup, investment through a leveraged retirement plan where it borrows through a non-recourse loan, that's going to subject the self-directed IRA to unrelated debt finance income tax. that tax does not apply to self-directed 401ks. That's one of the major advantages about a self-directed 401k, aka solo 401k, over a self-directed IRA when investing in real estate, is that you can utilize debt financing without triggering that 38% tax rate tax that applies when you leverage a non-recourse loan for investing in real estate through a self-directed IRA. So a self-directed 401k is exempt from UDFI. Another advantage of a self-directed 401k is conversions. You can convert pre-tax self-directed 401k funds through an in-plan conversion to the self-directed Roth 401k. Of course, that'll be a taxable conversion. But you can also do the voluntary after-tax conversion, known as the mega backdoor Roth self-directed 401k, where you make the voluntary after-tax contribution to the self-directed 401k and then immediately convert it to the self-directed Roth 401k or to a Roth IRA. This slide here goes over the process of doing a mega backdoor Roth self-directed 401k conversion. So first you have to open up a bank or brokerage account under the self-directed 401k to hold those designated voluntary after-tax contributions. You then make the voluntary after-tax contribution into that separate self-directed 401k voluntary after-tax bucket, aka bank brokerage account. And then under step 3 is where you convert those self-directed voluntary after-tax 401k funds to a Roth IRA or to the self-directed Roth 401k. And then step 4 is where you complete our online conversion form so that we collect the necessary information to populate that Form 1099-R, which is step 5, where we issue that Form 1099-R to Uncle Sam, and we'll provide a copy to you to report that conversion on your Form 1040. So that's how the mega backdoor Roth self-directed Roth 401k conversion works. This is a good slide because with the self-directed 401k offer for my solo 401k financial, you can utilize your local bank to hold the self-directed 401k funds, or you can use a brokerage firm such as Fidelity or Schwab. We have a great post on our website that compares Fidelity versus Schwab. So this slide here gives you some information on that front. But you get to choose where to hold your self-directed 401k funds. Many of our clients will use Fidelity because they can open up those self-directed 401k brokerage accounts online, so they don't have to fax anything to Schwab. They can just fill out the information online and open up those brokerage accounts for the self-directed 401k for my solo 401k financial. With Fidelity, you can also link your bank account for making those contributions electronically via ACH into those self-directed 401k holding accounts, so the brokerage accounts. With Schwab, you generally have to open up a separate bank or brokerage account at Schwab and then link that brokerage account to the self-directed 401k brokerage accounts to make those contributions. So it's not quite as streamlined on that front. But they're both good. Many of our clients have been using them for many, many years. The self-directed 401k also allows for the $1,500 auto contribution credit. So any plan that's drafted this year will automatically include that auto contribution credit, which was not available till the end of 2023. So if you are a client that opened a self-directed 401k with us, aka solo 401k, prior to the middle of December in 2023, your plan would need to be updated to include this auto contribution credit. So both existing solo 401k plans and new plans qualify. It's a dollar for dollar credit, which means that it reduces your taxable business income dollar for dollar. It works in $500 increments for a total of $1,500. So $500 in year one, a second $500 amount in year two, and a final $500 amount in year three. Not all self-directed 401k providers offer this type of self-directed 401k that allows for the auto contribution credit. So you'll want to make sure that whoever you use, that they offer this type of credit, because essentially the government is subsidizing your self-directed 401k for many years. Once the auto contribution credit gets added to your plan, whether you're an existing client or a new client, you can opt out. So you're not required to contribute to the self-directed 401k in order to qualify for the auto contribution credit. And that doesn't mean that you're not going to be able to make contributions to the self-directed 401k if you opt out. You can still contribute and still get that $500 credit and for 3 consecutive years. Okay, let's keep moving on here. The auto contribution credit is claimed yearly over that 3-year period using Form 8881. So you're going to file Form 8881 each year that you claim that credit in $500 increments for a total of $1,500 over 3 years. You can learn more about the auto contribution credit under Code Section 45T and Notice 2020-68. I'm also going to share a link at the end of this webinar here that talks about the auto contribution credit versus the tax credit, because there's a lot of confusion in the industry surrounding those two. We did a guest post on the White Coat Investor blog going over the differences between the auto contribution credit and the tax credit. So the self-directed 401k qualifies for the auto contribution credit. And again, I'll send that over a link to a post we did on that. Let's keep talking about the auto contribution credits and just such an important feature to the self-directed 401k. So if you have an existing solo 401k at Fidelity or Schwab or Ascensus or Vanguard, well, not Vanguard anymore, they no longer offer solo 401ks, but let's say T. Rowe Price, Chase Bank, or even Bank of America, you can convert that existing solo 401k to our plan through a restatement. And then we'll add that auto contribution credit to that plan. And you'll be able to start claiming that auto contribution credit in 2025 if you open that plan with us here in 2025. So you'll have it you'll be able to do that. You'll be able to claim that $500 credit for 3 years, 2026, 2025, and 2027. And then if you want to sign up for a self-directed 401k this year in 2025, you just need to do so by the end of the year so that you can qualify for that auto contribution credit starting in 2025. Now, again, if you're an existing client, you also qualify for that auto contribution credit. However, if you opened the plan with us before that auto contribution credit was available, which means if you're an existing client and you have a self-directed 401k plan with us prior to the middle of December of 2023, your plan will need to be updated for this auto contribution credit, and then you'll be able to start claiming that auto contribution credit starting in 2025 for 3 consecutive years. So you'll be able to claim $500 for 2025, a subsequent $500 in 2026, and a final $500 in 2027. Now let's go over some of the features of a self-directed 401k offered by my solo 401k Financial. And while I do that, let me send over that guest post I was mentioning earlier that goes over the auto contribution credit versus this solo 401k tax, or excuse me, goes over the auto contribution credit versus the tax credit. As the self-directed 401k, aka solo 401k, qualifies for the auto contribution credit. There's that link there to a guest post that we did on the White Coat Investor. Now, some of the features of a self-directed 401k for my solo 401k Financial, as I touched on already a little bit during this presentation, is that we'll take care of reporting for your plan, such as the issuance of Form 1099-R and Form 5500 Easy. And that's all covered in our annual fee of $125. It's important to know that our annual fee of $125 is for being the solo 401k plan provider. So as long as we're your solo 401k plan provider, which is a requirement in order to have a self-directed 401k, aka solo 401k. We'll also provide Form 5500 Easy and Form 1099-R reporting, provided, of course, that you timely request that from us. We don't have access to our clients' funds, so we don't know what transpires in your plan unless you communicate that to us. So for Form 1099-R reporting, that's going to come into play if you process a distribution or if you process a conversion, including the mega backdoor self-directed 401k conversion. So as long as you timely request that Form 1099-R, we'll gladly prepare that and file it with the government for you. Same thing for the Form 5500 Easy, which is an informational tax return that applies once the market value of your self-directed 401k is greater than 250,000. So you have to take a look at the value of your self-directed 401k as of the end of the year to determine the fair market value. For instance, if we're talking about a one participant plan, then let me get to that slide here. Then you're going to want to look at all of the holdings in your participant account. Excuse me, in your solo and your self-directed 401k. Trying to find that slide here. Let's see here. Where is it at? Here it is. So here's a slide for a one participant plan. So if you have funds in your pre-tax bucket, Roth bucket, and voluntary after-tax bucket, as well as investments, you have to add all those buckets and investments together to determine if the market value of your self-directed 401k is greater than 250,000. If it is, then the 5500 Easy needs to be filed for the plan. For example, if the fair market value of your self-directed 401k plan was greater than 250,000 as of the end of 2024, then a 5500 Easy is due to the government by July 31st of this year. So make sure you let us know. That Form 5500 Easy is very important. Here's an example of a two participant plan. So you would have to add all of the participants' funds. So both participants, for example, both spouses' funds in the plan to determine if the market value of that self-directed 401k plan is greater than 250,000 in value. If it is, then that 5500 Easy will need to be filed. I can't stress how that form is very important. There are very severe penalties that the government assesses for late filing of that 5500 Easy. They do offer a voluntary correction program where they'll charge you $500 per return, up to $1,500 to file missed returns under that penalty relief program. But you don't want to get to that point. Okay, so a self-directed 401k from my solo 401k financial also allows you to choose where you want to hold your funds, whether it's at a brokerage firm or at your local bank or credit union. We'll also assist with transferring IRAs, former employer plans to the self-directed 401k now or throughout the life of the self-directed 401k. We'll assist with calculating contributions to the plan. We'll do the reporting. We educate clients on the rules and regulations regarding investments, especially alternative investments like real estate. And of course, the self-directed 401k that we offer comes with the auto contribution credit. Okay, let's turn to some of the live questions here on the chat. Here's a question here from Brian. I am a sole proprietor, single member LLC doing aerospace consulting. Sounds interesting. I have opened a solo 401k in 2024. I want to add the spouse as she does bookkeeping. I'm wondering if treating her as 1099 independent contractor or W-2 is the best method in the eyes and best path to having her contribute to her account under the self-directed 401k plan. So typically when it's a LLC that's taxed as a sole proprietorship, then your spouse would get added to the plan if she's not on the plan already. And then she would file a separate Schedule C under that LLC. So two separate Schedule Cs would be filed under that LLC, one for you and one for your spouse. One thing you may want to consider after you talk to your CPA is electing S corporation status. So you can still operate under an LLC, but have it taxed as an S corporation as opposed to a sole proprietorship. Reason being is that when making contributions to a self-directed 401k plan, when the self-employed business is taxed as an S corporation, so whether it's a standalone S corporation or an LLC taxed as an S corporation, it's going to take less self-employment income to make those contributions, because contributions to a self-directed 401k, when the business is taxed as an S corporation, they're not going to be subject to reducing those W-2 wages by 1/2 of self-employment income tax when making the contribution. For example, let's say you pay yourself $100,000 in W-2 wages from your LLC tax as an S corp. Let's further assume you want to make an employer profit sharing contribution, which is percentage based. Let's say it's 25%. You're going to be able to contribute 25% of those box 1 W-2 wages for a total of $25,000. Now, if you do that under a sole proprietorship, you're going to look at Schedule C, line 31. And let's say that line 31 is $100,000. Well, that's just the starting figure for that solo 401k contribution calculation. That $100,000 has to be reduced by 1/2 of self-employment income tax. So therefore, instead of basing that employer profit sharing contribution on $100,000, you're going to have to base it on the difference of $100,000 minus 1/2 of self-employment income tax, which means it takes more income to maximize self-directed 401k contributions when the self-employed business is not taxed as an S corporation. So to finish answering your question, if you want to stay as a sole proprietorship where your LLC is taxed as a sole proprietorship and you want to pay your spouse on a W-2, you can check with your CPA on how to do that. I'm not sure if that's going to be doable because you've got LLC sole proprietorship status, but again, we're not business. We don't set up businesses, so double check with your CPA if issuing a W-2 for your spouse is a good idea, because payroll taxes are going to apply. Here's a question here. What happens if you set up a plan by December 31st and you designate employee contributions amount in the W-2 by 1/31/2025? Later, you file the 2024 S Corp return by September, but you decide you no longer want to contribute for 2024 as designated in W-2. Would this be an issue, or would it be simpler as amending a W-2? Is there a penalty for such an action? Where would you list the intended employee contributions in W-2? All right, this is a loaded question here. Let's see if we can dissect these questions here. So you opened the plan by December 31st of 2024. You designated employee contributions on your W-2. You later file your return by September. You decide you no longer want to contribute. So it's not whether you designate contributions or not. What matters is whether you make that contribution. So if you make that employee or employer contribution for 2024 here in 2025 by your S Corp business tax return due date, you can keep it in there. If not, then you can remove it as an excess contribution. If it's made as an employee contribution, it can be removed as an excess contribution by April 15 of 2026. If you make it as an employer contribution, it's going to have to stay in the plan, but you can treat it as a 2026 contribution. As far as amending a W-2, that's not really going to help, because once that contribution goes into the plan, it doesn't mean you can amend the W-2. Once it goes in the plan, it's got to be removed, and it's got to be reported to the IRS as a removal of an excess contribution if it's an employee contribution. If it's an employer contribution, it's got to stay in the plan. Let me send over a link that talks about those excess contribution rules because they get really, really quirky. You got to approach them from an employee versus an employer contribution. Let me bring that up here. Here's a good link that goes over those excess self-directed 401k contributions, how to remove them. There's that link there. Okay, let's look at another question here. Here's a good question from Patrick. I did not think Fidelity would permit a self-directed 401k to invest in alternative investments. Yeah, a lot of people are not aware of that. Fidelity offers their own solo 401k plan, which of course does not allow for alternative investments, but they will provide investment-only company retirement brokerage accounts, known as non-prototype brokerage accounts, for a self-directed 401k, aka solo 401k from a company offered by my solo 401k financial. So my solo 401k financial would be the self-directed 401k plan provider, and we would help you open up the holding accounts, brokerage accounts over at Fidelity. Let me send over a link that compares Fidelity's solo 401k with the self-directed solo 401k from my solo 401k financial, which can be invested in alternative investments. You'll be able to wire money or write a check for investing in alternative investments through that self-directed 401k brokerage account at Fidelity. So I just sent over a link that talks about that. Let's look at the next question here. I have an LLC taxed as an S Corp. I have my solo 401k set up in time for 2024. I'm looking to do contributions from employee and employer sides. I have already done payroll for 2024. Okay, great. Well, you're going to be able to contribute for 2024, both employee and employer contributions to the self-directed 401k because you went ahead and opened that plan by December 31st of last year. Now, even if you open the plan here in 2025, you could still do employer contributions for 2024 by your business tax return due date plus extension. That you've got Secure Act 1.0 to thank for that, where it extended the contribution deadlines for anyone that opens up a self-directed 401k in 2025, where they can make employer profit sharing contributions for the prior year, so for 2024. So yes, you're going to be able to report those employee and employer contributions for your S corporation for 2024 here in 2025 when you file your business tax return. So you still have plenty of time. You've got till what, March 15 to make those employee and employer contributions, or if you file for an extension, you're going to have until September 15 of 2025 to make those 2024 contributions. Looks like you got another part of your question here. When completing docs for real estate syndication investment, is correct that a solo 401k is legally recognized as a revocable trust? So if you're doing a real estate syndicate investment here, the investment sponsor is going to issue a Form 1065 at the end of the year for that self-directed 401k investment. So there's a box that you're going to that investment sponsor needs to check off, titled retirement plan. So yes, a self-directed 401k is a retirement trust, which means it can be amended, which means it's revocable. Revocable means that the self-directed 401k can be amended. So yes, it's a revocable trust from that front, but it's also a retirement trust. So let me send over a cheat sheet here that you can look at regarding the Schedule K1, which is the form that's going to be completed by that private equity investment firm to report the self-directed 401k investment in that private syndication. Let me share that with you here. I just went ahead and share that with you. You're going to look at that and you're going to see that there is a that Schedule K1 under Part 3. They're going to ask for they're going to ask you to list the name of the self-directed 401k under H2. And then there's also a 10, which is where you list the employer identification number for the 401k. And then you're going to want to make sure that box 12 is checked off, which lets the government know that it's a retirement plan that's investing in that private syndicate, and therefore it's afforded tax treatment, tax shelter status, that is. So it's not going to be taxable to the plan. Okay, let's see here. What else let me look at some more questions here. Oh, here we go. Looks like Michael had a follow-up question here about their payroll company. My question is my online payroll company will not let me do anything with 401k for 2024. So I need to do an additional W-2 before 131. Well, I know that Gusto is a popular payroll company, and they will amend the W-2 if you in fact had those W-2 wages by the end of the year. So you would let them know, and they would amend that W-2. So you may need to find a new payroll provider, or explain the rules to that payment company. Or alternatively, if we're talking about employee contributions, you can actually base those contributions on that W-2 gross wages, and you don't have to report employee contributions on your W-2. If we're talking about employee contributions, instead, you can choose. And I went over this slide earlier. Let me see if I can pull up that slide here. Here it is. Take a look at the slide here. Remember, employee contributions. Let's pull it up here. Let's get to it exactly. So employee pre-tax contributions, they can be reported on Schedule 1, line 16, or they can be reported in box 12 of the W-2. So you don't have to report those employee pre-tax contributions on the W-2. You can say the heck with the payroll company and report those on Schedule 1, line 16 instead. Just don't report it on both boxes or lines, because you'll be double dipping. So hopefully that gives you some guidance there. Let's keep going here. Let's see. I have a client who has a part-time employee. Can they set up a solo 401k? Does it matter if they are LLC, taxes, sole prop, or S corp? Great question. So as long as the part-time employee is working less than 1,000 hours, then your client would qualify for a self-directed 401k, aka solo 401k plan. So going back to that slide we talked about earlier about the eligibility requirements. So as long as the self-employed business does not employ any W-2 full-time employees that work 1,000 hours or more, then you can open a self-directed 401k, and any entity type can establish a 401k. So it doesn't have to be an LLC or an S corporation, but it can be. Many of our clients are S corporations, LLCs, and they're also sole proprietorships. Okay, here's a good question here. Can I do 2024 employee contributions to a solo 401k plan that's set up in 2025? This is a great question. So it depends. So the Secure Act changed the rules for contribution deadlines. So if it's a sole proprietorship, then I've got good news for you. You can still open a self-directed 401k plan here in 2025, but you have to open it and make the 2024 contribution to it by April 15. So under the Secure Act, it changed the rules for employee contributions, but only for sole proprietorships, which means that as long as you open up a self-directed 401k, aka solo 401k plan here in 2025, and you do so by April 15 of 2025, and you make that contribution, that employee contribution, by April 15 of 2025 for 2024, then yes, that's an option. I'm going to send over a link that talks more about that. Now, the employer profit sharing contribution for 2024, that can be made by October 15 of 2025 for 2024. So that one doesn't have to be made by April 15 if your self-employed business is a sole proprietorship or taxed as a sole proprietorship. Let me send over that link specific to the sole proprietorship. So again, the regulations have really muddied up the waters regarding the contribution rules, the contribution types, the contribution deadlines. It's all dependent on your self-employed entity type. Here's a link I just shared with you specific to your question. If we're talking about a sole proprietorship business and LLC taxed as a sole proprietorship, if it's an S corporation, then it's too late to open a self-directed 401k here in 2025 for making employee contributions. The plan had to be adopted by December 31st of 2024. That is, the plan documents had to be signed by December 31st of 2024 if your business is taxed as an S corporation in order to be able to make employee contributions in 2025 for 2024. Let me send over a link that talks about those rules. We have all kinds of links because of the darn rules here, all the changes that were brought on by Secure Act 1.0 and 2.0. Here's a link for an S corporation. And I'm also going to send the link to the December 31st self-directed 401k setup deadline so you can see all of the setup deadlines for all the self-employed business entity types, S corp, partnership, C corporation, sole proprietorship, so you can have some fun like we have fun. Okay, here we go. I just sent that over. That'll keep you busy for a little while there. What else do we have here? Let's look at some more questions here. Keep in mind, we're going to have another one of these at 1 p.m. Pacific time today. Let's see here. Here's a good question here. Do I need to report each after-tax conversion as it happens? Or can I report it once at the end of the year and include all gains in one amount? Great question. So it's best to just report them all at the end of the year to us. So any conversion that you process this year, let's say you process voluntary after-tax conversions and you do 4 or 5 of them throughout the year, you just need to submit one form to us by December 31st listing the total amount converted, because we only need to issue one form 1099-R to report the total amount of voluntary after-tax funds converted during the year. So just one form needs to be completed and just one form 1099-R needs to be issued. Okay, I think we're finally coming to the end of our session here. All right, everybody. Well, we really appreciate you attending today's webinar regarding the self-directed 401k, top things to know. And hopefully we got some good material out here and answer your questions. And again, we'll be back here at 1 p.m. Pacific time today. Until then, have a good rest of the day.